as I have to bolt just about at the top of the just a little bit after. So I won't drone on for 39 minutes like I did last time. Apologies for that, but we'll try to cover everything that we possibly can in that period. Okay, so we're recording.
Tim, can I ask for you, and can I ask for you that people mute themselves unless they're talking? Because yes. My attention span is so short that throws me
too. Yeah. If you haven't done this before, even if you're a veteran, remember the two ground rules: mute yourself, because I can never figure out how to mute you. I have to find you. Mute yourself unless you're talking. And number two is please ask questions, fire away. You can interrupt me at any time. You know, this is for you guys. I want to try to do everything I can to help you use the platform effectively. I do, you know, it's not perfect, but it works very well if we are disciplined with the math. And so I just want to help you do that as best as we can. So thank you, Raven, appreciate that. Okay, let me get rid of that. And now share my screen. Okay, here we go. All right, we'll kick off here. This is exactly where I want to kick off. So, you know, my general aim here is to talk about broad sentiment, context, divergence. Those three things I come back to all the time. We'll go through a bunch of examples to help you see the things that certainly the math tell us is what we want to look at. And I wanted to start with broad sentiment. You know, the broad sentiment's the risk management tool. And when it gets high and begins to decline, stocks tend to fall. And when it's bottomed and rises, particularly back over 5, the market tends to rise. And if you looked at the, call it the 10-year history, the market trades around 5.5, trades between the green line and the red line most times, if you took an average. And so when it's above the red line, the risk increases that it declines. And you say, well, Quast, it doesn't appear to be declining. Well, this is a very long top. And I think this is an important point. It has. I mean, if you look at where the market was and where it is now, while it feels like it's rising, we've been taking, one step forward, 2 steps back. And so that is what you would expect when broad sentiment is very strong. Doesn't mean it's going to be linear, that we were here. So again, the green part, this is sentiment, algorithm, taking the different purposes and time horizons that drive buying and selling and weighting it on a 10-point scale. And if it's above 5, excess demand, above 6, above 7, really excess demand, tends to mark short-term tops. Those tops can be short. They could be this is a very long top. This is unusual. And that can mark a turning point. I'm not saying it will, but it's, you have to be aware of that. And this is SPY, price of SPY. So, you go back here to August 3rd, and it was, call it 414. And as of the 24th, it was 414. So it hasn't risen. There's certainly been ups and downs, but in point of fact, if you have gained really nothing during this period of time unless you were able to trade things like we were. I traded things into options expirations that produced my best dollar return ever. A large trade in Crocs, and there were a number of things to trade well. And you might say, well, why, Tim, if the market if the demand is falling? I hope you can see that. Can't make it any bigger. It doesn't appear. If demand is, it's okay. Okay, if demand is falling, why are prices rising? Well, there's cause and effect. There's a delay. I think somebody's knocking at the door. Hang on 1 second here. Okay. Jackie, you haven't missed much. We're just getting started. So, again, if the demand is falling, why is the market still feeling like it wants to rise? It's up a little bit today, because there's still excess demand. It's just that the trend's beginning to deteriorate, and it's been a long stretch. It went right from, I would say, coming out of July options expirations. That's where we had real leverage. We get to August expirations, and the leverage reset at a lower level. To me, there's no question in the data. The key reason, though, that the market has done so well is this monumental drop in the supply. There is supply. Every market has a supply chain. Grocery stores have a supply chain, and it's the reason that you go in, well, they're out of spinach or whatever. The supply chain hasn't delivered it. The stock market supply chain is short volume, not short interest. Short interest is a measure that it's really a monetary measure. I'm not saying there's not application for it, but the way that the market really works today, post-regulation national market system, 2007, we went through the 2008 crisis and 2009, and there were some rule changes, is that the supply of shares in the stock market depends heavily on borrowed stock. And that's what we're measuring. So you can look at short interest and say, oh, that's 2% of the S&P 500. Well, that's not an accurate read in a supply-demand terms of what's really occurring in the market, where the trading periods are very short. The whole market is very short term. 75% of market volume is, in a sense, quantitative. It's either trading by firms like Citadel and Virtu and Hudson River Trading. These are market makers, proprietary traders who engage primarily in arbitrage. They call it market making. That is 53% of market volume. And then 20%, a little over 20% comes from indexes, ETFs, and quants. Those are managing fiduciary assets and deploying it following models. And so do we. Right? I've got financial advisors, and we follow, weighted models, balanced models, target date funds, all that kind of stuff, right? So let me do this one more time. Let Arbati in here. There we go. Okay, so the supply chain now is really dependent heavily on borrowed or created stock. And once again, market makers are exempt from having to find it. I met with Virtu last week in Austin. Did I? I think I mentioned that to you. I mentioned it last week. And we talked about this. But here's the real reason that the market did so well. We went from almost 49.4% of market volume coming from borrowed or created stock back on July 7 to a bottom here of 45.2. It doesn't sound like a lot. That is a monumental drop in supply when there's hardly, as a trader, very difficult at times to fill trades because there's nothing there. You put in a limit order and it doesn't get filled, right? And why is that? Because there's no supply. And arbitrageurs are constantly assessing supply and demand and determining whether they're going to move the price to fill your order or not. They don't do it for it's all about self-interest. So now we've had a sudden spike in those levels back above the trend, and the demand side's beginning to come down. That's why I look at the market and say, well, the propensity is that the market will have downside. It's not linear. It will, but that's what we, if I look at where the top was, has the market risen? No, it hasn't dropped because demand has stayed very strong. But as that deteriorates, and as and maybe it'll change. Look, we'll just look at the data. I'm not predicting outcomes more than 5 days out off of this data. I look at this and say 5 days out, based on this data, the probability is that the broad measures will be lower, not higher.
Can I jump in real quick?
Yes, please do.
Because we're on this topic. I've been taking notes because I branched out on my own, opened my own company, so I've been kind of falling behind. But based on this conversation, what you're talking about, one of my problems is for what you're talking about right now, because we were saying sometimes you see it going up while when it should be going down. How long does it take on average, statistically wise, before you start to see a sea change? Because I told you before I got here, I was doing like day trading and someone showed me and it stuck in my head and I shouldn't do it. But if I don't see a move right away, I start freaking out. So if I see a decline on average, how long do I start to see the reversal of what I want when the price go up? And I have a hard time. I still can't get over not looking at price. So on average, how long are we looking to be in it? I've been in a stock where the broad sentiment was 10 and the price kept dropping, because it stayed at 10. I freaked out. I got out. So those are my two questions right now.
Okay. So for me, it's 1 to 5 days. And the trend is going to be 3 to 10. I always come back to about 5. And why is it about 5? because a lot of money will rebalance things over 5 days. There is T+2 to settlement. So if I've got a large position, I will want to leave enough time to clear those positions. So you could add that on and say there's about 8 days. The market very much functions that way. One other thing to keep in mind is these little green squares. Options expirations change outcomes, and that will change the nature of the math because it's an interfering mechanism. It's derivatives that are implied but not actual supply or demand. And so when there are changes to that, and by the way, there was a 2% drop in demand for derivatives. We can measure that. Well, the market went down. The S&P 500 went down 2% after options expired. So those things will warp it, but that's how I think about it. If I get my 2 or 3%, if that's what I'm after, and that happens in a day, I take the money and I will repeat the process. If it takes 2, 3, 4 days,
if the price is dropping, but like you get in and your broad sentiment still stays at 10 and it just drops right away, are you getting out or are you going to wait?
I always will follow those 3 things. Broad sentiment, what's the broad measure doing? If the broad measure is deteriorating, now my risk increases. And it will decrease my commitments to positions like that. If it's moving in my favor, context, is there anything happening? Options expirations, that's earnings. I don't want those things interfering. And then I know I've got good divergence, then I don't care if it drops the whole intraday volatility. You've missed a lot of that discussion about volatility. That
was my other question. How do you use volatility? I heard you talking about when you get out, when you get in, it was 4%. I missed that. Yeah, I did.
Yeah, so let me use. I bought, and it's a harder. I've traded this stock a fair amount, but I bought this today. Whoops, I bought Laredo Petroleum. Not super liquid, so it's not. I'm not crazy about it. What is the deal? What am I doing wrong? It's just me. It's just user error. So here's what I mean, and we'll look at this in the portfolio view too. So first of all, look at the supply-demand equation. I like that demand has just gotten to 10 and that the supply side has dropped below trend. That divergence, all other things. Now, if everything was rising, the probability that I get a return is better than it is right now. So I'm happy with that. I know broad sentiment is deteriorating. So then I'm going to go look at this in a portfolio view to check the volatility. And it may or may not influence entirely what I do. But let me just pull up energy here, and you can just look this up by ticker. So I'll go over here and look for LPI. And I want to see that it's got daily intraday volatility of 6%. So if it's down, even if it went all the way down 6% today, I don't really care. I mean, I'd prefer to buy it if it's down 3, 4%. I bought it down just a little bit. But I'm certainly not going to worry if the price moves 6% because that's normal. It moves that much every day. And what that's telling us is the spread between the intraday highest and lowest prices. And it's quite significant in the broad market.
So if it's 6 here and you went to investigate it and it's only at 2%, you see as an opportunity to go in?
I still would buy it. Yeah. Yeah.
Okay.
And then if it goes in it it went down and now I'm underwater. Well, I don't care. I mean, oil's down today, so there's going to be a commodity effect. The people who follow trends and trade commodity pairs, things that are tied to oil like this, sure, that could drag it down. But I know that mathematically, the probability is very, very high that in the next 2 days, it will move 6% favorably. Might just be intraday, but I'm certainly going to pay attention. I know that generally that math is on my side. That doesn't work perfectly, but that's how I think about it. And when I see that, I'm just doing it. And I don't overthink it. I mean, I immediately looked at how I got to that today was, I always look at big and stable, 10 in that. I go look at the momentum portfolio. We're clearly not in a momentum market anymore because we've gone from 36 to 3. That's just math following some rules, and it's not perfect. It misses some stuff, but that tells me there's not a lot in there. But I'm going to look at what's in there and say, okay, well, Denbury's in there. There's another energy company, EQT, 2 of 3. One's an insurer and 2 of them are energy companies. And that you can see right here. So I go, well, money's there, right? That's if there's momentum, it's probably in energy. And then I would go look at the volatile 10s as well and say, okay, what does that show me? Because these are things that have even greater intraday movement. And Sure, you could hunt around. I could go look at the energy sector and go to all the stuff that is 10 with a downtrend in short volume with less than 50%. You can very quickly narrow that sort, but I don't even most times take that extra effort. I will look at energy and say, okay, it is probably the best sector of all these portfolios. So many of them have declining demand and rising supply everywhere. And you say, well, the market's up. It's a predictive indicator. It's telling us something is coming, not that it's arrived. And it probably comes in the next 3, 4, 5 days, right? So I look at volatile 10s, only 4. Energy's the leader. So there you go. And I look at that. There's Laredo. There's EQTs in this one too. And Laredo on semiconductor has been a great stocks. This SMCI, if you traded it the last couple of days, you can make money in that. But that's what I do. So then I just say, well, I like the fact that there's an uptrend in Laredo out of all of those. That just means it spent one day at 10. So, and 45% short volume, 46. 30-day trend is down. I'll look at what it's doing the last day or two. But I look at that and say, okay, well, I'm not going to push my whole chip stack in, but I bought some size in that. And I don't care what it does today. My time frame is 2 or 3 days. That's how I think about it. So yeah, I'm very happy if it stays in this range. And do I stop myself? I don't. I'm not saying that you shouldn't. I'm not a big fan of those orders. I'd rather execute the trade myself. If something changes in the supply demand equation tomorrow, if all of a sudden supply jumps, I'm out. And I don't mind if I lose a few $100s on that because I'm just going to follow the math. But I know the odds are in my favor. So that's what I think about all the time. It's those things.
So would it make sense, let's say you go in at 50 and say you set 2%, 3% profit, automatically sell, so I don't have to sit in front of the computer and execute if it hits it?
Sure, you can. Just realize that a machine will know that you did that. And so the machine gets to determine whether it fills your trade or not. And generally what that means is you don't get the best price. Right? So your broker will sell that trade to let's say Citadel. Now Citadel knows what the supply demand balance is in the pipeline. They'll deny it, but I know it. Know that they know what the limit orders are. And so if they fill your limit order, it's only because they believe that the supply and demand balance is in their favor. And I could show you how often my own broker takes the other side of my trade. So all my trades in LPI today, which I did as marketable trades, one marketable limit trade. So I put in a marketable limit trade within the bid offer spread, and then I bought it at the bid. And then my other trade filled at a better price, and it brought my cost basis down to exactly the midpoint of the spread. So I'm fine with that, but I stuck my own broker taking the other side of that trade because they couldn't send it to anybody with a better price, and that's the law. If my trade is for less than 100 shares at the bid, my broker must match that trade if they cannot find somebody who will. That's the law. It's the only way you have a continuous auction.
So you sell at the bid, okay.
Yep.
Will you buy a stock without knowing the stock itself, like just based on the math?
Yes, I do it all the time. Now, I'm very careful about stocks that are not liquid. I could give you a great case in point. I had a discussion with this company today over on this not trading. This is our corporate side of the business. So our house is a furniture company. Just had a tremendous return. They're up 62% since July options expirations. So just an extraordinary run. And you can see the excess demand, downtrend in supply. It's rising the last couple of days. If you were in it, you should leave. Right? There's your signal. That's your sell signal. Great demand, still below trend, jumped above trend, I'm out. That's how you know. It's not more complicated than that. And you don't have to scrutinize a chart and try to figure out the candlesticks and all that stuff that is not reliable because it does not take into account the kind of money that's responsible or the supply-demand balance. You have no idea. And I want to give you an example of that in just a bit. But I would look at this in a portfolio, and here's why. And I told her this. I told the person, I said, here's your problem from the standpoint of institutional money, attracting institutional money. The reason Fidelity will not buy your stock is here. I'll show you why. It's not liquid enough. Doesn't matter what the volume is. You know what Fidelity cares about is, can I move a position? Well, it's 6.2% volatile, but it only trades $826 at a time. The fact is that the average trade size, it trades 4,500 times a day, that gets filled is $800. I'm not trading that. I will trade my sort of baseline is $4,000. I need 5 times the liquidity before I'll trade that. So notice that LPI, while it's only got about the same size of market cap, it has a much larger trade size of $4,200, $4,500 a trade. I'll do that because I know I can get in and out. I may have to chop my trades up, but I know I can sell at $4,000 at a time. So I think about that stuff because that's how you lose all your return. The stock goes up 5% and you try to sell it, and all your return gets consumed just getting out of the stock. So just beware of that. Yeah. And that yes.
I'm sorry, just on that, I saw an association. I keep seeing over and over, and you don't talk about it, so it's probably wrong. But every time I see the market makers increase their available stock as the supply goes up, more often than not, I see a correlation in price rising. It's like running down a football field. You hit a 50-yard mark at full speed. It's going to take time to turn around. I always see an acceleration in price in general. I could be wrong, but that's probably wrong to assume, right? Or I shouldn't count that in.
Well, it's so you understand why that happens, and then it gets to your time frame again. So, and here's a great, this is a perfect answer to that question, Milan. So an Edge user sent me a note, said, so I know lithium really well. And I look at this and, so the demand is falling all the way down here to 1.8, and supply has skyrocketed up here to 47%, and the stock is shooting up. Now I know fundamentally it's in a very good position in the market. So isn't this data wrong? And I said, well, it's important to understand what that data means. There's no question that when demand diminishes dramatically, if some shows up, the curve will change. I much prefer owning things that here's where I would, at this dip, would I probably sell? Probably. I'd probably have left here because supply is rising and demand is falling. Well, the price is no better here than it is now, barely better, right? So I could have ridden it down, but that's still my preference. Now, all through this period of time, there's excess demand. Now there's insufficient demand and excess supply, and the stock skyrockets. What is happening? Well, this is market makers creating stock to fill orders. That's what they do. If there are a whole bunch of retail trades, and they're all for, let's call it, 100 shares, and they're all above the midpoint of the bid offer spread, that is between the best bid to buy and offer to sell, they'll never be the same. And so to have a marketable trade, you have to be between them, and you may or may not get filled. The only way you will absolutely every time always get filled is if you trade 99 or 100 or fewer shares at the bid. That will get filled because it's the law. But here, that market makers look around like there's nobody selling the stock. I can't get any supply. We'll borrow it. They just call it borrowing. So that's what he's seeing. So that will cause the price to stop rising, though, because it's artificial supply. There's great demand, and this could turn. This could go right back up, and demand could surge, and the price could rise further. But that's why. It's nothing wrong with the math. The math is telling us where it is and why it has risen in the last couple of days, and it is manufactured stock. This will have to be squared, though. Market makers are not going to stay. Okay, they can't beyond 36 days. But as the guy at Virtu said, and we looked at their data, it's like, and you can see it here. Excess demand, supply covered, excess supply covered, and there's still insufficient supply. So price didn't fall much, even as demand was coming down. Now excess supply, this is the biggest spike. So at some point that's going to have to dip. I'd prefer to buy that dip, right? If demand is rising and supply falls, I'll buy that. I don't like this because you can get chop blocked. You could give up 10% in a day and you'll go, what the heck? And it was a supply demand imbalance. It still can go, it can go up. There's not a lot of demand. So if there's a buyer, it will move the price, but that supply demand balance has to be smoothed out.
Hey, Tim, question for you. I know you use interactive brokers for your trading and so forth. I use TradeStation, and they have the ability, to do an automatic routing, the best routing for your orders. but you can also choose to go right to the exchanges. Is there an advantage to that? What does that get around market makers looking at your what your limits at if you do a limit order? What would the advantage or disadvantage be for that?
Fantastic question. That is a great, arcane, weedy market structure question.
Mm-hmm. I figured you'd know.
Well, absolutely. So, the professional traders say that the displayed markets are always the last place to go because that's where everybody gets picked off. So I know if my trade ends up at the NYSE, that's probably the top of the market. But you can choose to, what you're doing is directing your order, and very few retail traders do that. You can look at there are filings called 606 filings, and you can see how Schwab routes its trades and what percentage of them are directed. Very, very small. Almost 100% of trades are non-directed, meaning that the broker is choosing where to route them rather than the user. You could do that. The trouble with the exchange, and I'm not knocking it, is the exchanges pay people for the bid and the offer. So a greater percentage of trading volume on exchanges tends to be high frequency trading, short-term arbitrage. So all the exchanges operate what are called inverse markets or inverted markets, where you get a trading credit. It's called a rebate. But for instance, we take SIBO. One of their markets will pay you to buy, and another one will pay you to sell, about, call it 30 cents 100 shares. And so high frequency traders will hit those to consume that 30 cents and try to set a bid and offer. Well, that will draw your trade to that market because they will have the best bid and offer. But the prices have been set by machines that have all the data. So the chances that you get comparatively worse prices is higher. I would prefer my trade to be executed in a dark pool, and probably that's because I know that it's more likely to be between the bid and offer and more likely to be stable. In fact, if I see that all my trades are executing in dark pools, I know that the stock's probably going to rise because there are other buyers in there who are just as smart, who know where to be. Then you sell on the exchange where all the suckers are, and then the price goes down. So I prefer trades to be in the dark, not in the displayed markets.
Makes a lot of sense.
Yep. Okay. And we're almost out of. I'm going to have to run, but I want to hit some more examples because I think those are most important. I'll tell you, it's hard for me right now to find a lot that I like. I bought Consolidated Edison today just because I want to have an offsetting. It's not going to do well on days like today because the market's up a little bit and people are chasing the last little bits of momentum, which is very sparse in the market. But I know that this is pretty good. If the market is bad, and I'm not saying it will be tomorrow, I think the worst case is Monday, Tuesday, and Wednesday next week. And why? Because index futures expire on August 31. And I know for a fact, I can see it in the data, passive money is weighting away from equities. You don't see the effect yet because there's cause. And where do we see the cause? Rising short volume. It's shooting up in the broad market. Well, it works both directions. If it's been very low and the market has gone up and there's been a lot of money buying, and then short volume goes up and demand is falling, what's it likely to be? That's market makers creating the other side of the trade, which they will flush. And so I'm not saying the market's going to fall apart. I'm just saying I will have this position to benefit from that, not from what will happen today. It might make 2%. So, and that will be a Milan 2, 3, 4 day trade. But beware of that. I think that next week, so T+2 would be Monday, right? Monday, Tuesday, and Wednesday. I think even tomorrow, people are really conservative would want to be out. I'm not saying that that's going to happen, but if tomorrow isn't as good a day, you will know why. That's what's happening. So a couple of additional examples here. So let me show you Consolidated Edison. Of course, this is a little longer view here in the portfolio view, but I look at that and say, well, it's a very stable 5, and sometimes it'll be higher, but it always reverts to 5. This was the bottom of the market, so everything was bad. Right at June options expirations, then here, where is it? Well, there's insufficient supply, so I know that other people are using this as a hedge against volatility. Okay, so I'll own some of that. As the market falls, this will rise. So I did that. Then Laredo Petroleum, only positions I've got right now. I'm not crazy about anything I'm seeing, frankly. I look at, Denbury, pretty good stock, right? I'm very happy to own this. I don't at the moment, but it's a very long time to be a 10. There's the price. It's done great because supply fell and has stayed right at trend. No big fluctuations in that. That's very good support for the price, right? Great stock to own. When do you leave it? When either side of the equation changes. If this jumps up, you're out. You can find something else. But of the two, I decided to take LPI. So AR, Antero, we've mentioned the natural gas stocks have done well. EQT, not every day. They're volatile stocks, but that's pretty good, right? It's a 10 for 4 days, and the supply side just fell. Well, that's pretty darn good. Doesn't mean it'll be up today. If it's down today, that's even better because there's a probability that you get a good return. That's what I look for all the time.
Just ignore the price. Just look at the chart indicators.
I don't, I'll tell you, high frequency traders don't look at price. Passive money doesn't look at
price.
Right. But what matters with price is volatility matters. What matters is the probability that what you pay, whether you're long, short, whatever you do, that what you sell it for is better than what you bought it for. And you just want to improve the odds. You don't want to be guessing at it. I mean, you can't that stock's up the last couple of days. I think I'll buy it. On what basis? Right? What's your reason? Here you have a reason. Very strong demand, falling supply. The broad market, there's an event next week, and broad sentiment, well, it's starting to deteriorate, but energy is the best of everything in the market right now. That's stacking a lot of probabilities in your favor. And so, if the stock's down today, don't worry about it. There's a very high probability it's up tomorrow. So that to me is far and away the best thing to do. This is a very informed way to approach the market because it considers everything that everybody else is doing and the rules and supply and demand. So I'll leave you on that note. I'm 5 minutes late, but it's okay. So I will do this again next. Yes, I've got a trip coming up, but next week let's do this again. So is that good? Any last?
Yes. Yes.
Good. Okay.
Question.
Yes. Okay.
Will you address the 10-year yield and that this is the fourth time this year that it's gone above 3? The first 3 we crashed.
I think it's meaningful. I do. And of course, Jay Powell speaks tomorrow, and they're important. People bet on that. The reason it moves the market is because people bet on it, not because rational thinking people are reacting to what Jay Powell says. But I agree. I think it's just another indicator of things that I'm seeing everywhere. I don't think we're in a great spot. I said with this long top that I expected the market to have good days and bad days, but to stutter and stumble and maybe begin to crumble. We had that 640-point down day with new options trading. That's not good. It tells me there's insufficient demand for derivatives, and I think it's a dangerous market. I do. So I think I'm going to trade the high probability things, but I think that's just another signal, Steve, that it's dangerous.
Yeah. Okay.
Okay, you guys. Good to see you. Thank you very much.
Thank you. Recording. Thank you.
Thanks, Tim.
You bet. Good to see you, Barry. I'll alert you to the leaves.
Fall colors. Yes. Thank you.